We are researching in detail today something that honestly should fundamentally change how every professional trader, maybe even every corporate insider, views information advantage. For those of us who spent years in, private equity and M&A, walking that tightrope, meticulously avoiding the SEC line.
Yeah.
This feels like discovering a parallel universe.
Yeah, it really does. A universe where the old rules just poof, gone.
Exactly. Poof.
It's kind of the ultimate reward for tracking the signal, right? Which is what we're all about here. The legal sources we've pulled together, they aren't exactly subtle. They're calling it the starkest regulatory arbitrage opportunity in modern finance.
Starkest. That's a strong word.
It fits. We're talking about crypto prediction markets, specifically Polymarket, and how the tech has just completely outrun the regulators, creating this weird two-tier system for cashing in on information.
And this isn't just theory, right? We're talking documented profits.
Yeah.
Big ones.
Tens of millions. Easy.
Yeah.
And it's all happening because possessing and acting on material non-public information, the exact same stuff that gets you federal prison time if you trade stocks on it, is perfectly legal over there.
Perfectly legal. Wow. So, okay, our mission today, let's get into the weeds. How does this gap even exist? Why is serious, sophisticated capital suddenly flooding into this space?
Right.
For everyone listening to the Insider Signal, look, we've always focused on tracking where information flows first. That's the game. But now we have to talk about where that same information flows without consequence. That's a whole different level.
It really is. And we should start with maybe the most precise example imaginable. The timing is just incredible. The Nobel Peace Prize leak.
Yes. Perfect illustration. Clean, immediate monetization of what has to be a serious breach.
Exactly. So the winner, Maria Corina Machado, was officially announced October 10th, 2025. Standard stuff.
Okay, but the trade. Give us the timeline on the actual market action.
11 hours, that's the window, 11 hours before the public announcement, massive buying volume just explodes on the Polymarket contract for Machado.
Explodes how?
From what level? Well, her odds had been totally stagnant for months, like pennies on the dollar.
Yeah.
Maybe 3.6%, translating to like 3 to 8 cents a share. Basically zero chance according to the market.
Okay, background noise level.
Totally. Then boom, 11 hours out, the buying starts. The price doesn't just edge up, it skyrockets. Blows past 50% certainty, hits over 70% super fast. And it holds there, guaranteeing a full $1 payout when the news hits.
1,000% return, basically overnight, based on certainty, not just a good guess.
Precisely. And you have to remember, the Nobel Committee's decision, that's kept incredibly tight, super confidential, usually finalized only maybe 4 days prior, and the winner themselves is often only told hours before the public announcement.
So someone new, someone with direct access.
Someone absolutely new. The blockchain forensics are pretty clear on this one. There were 3 specific wallet addresses, accounts, that collectively pulled in nearly $300,000 in profit.
Wow. Any standouts?
Yeah, one in particular, identified by the wallet cluster analysis guys as Dirty Cup. This account dropped a massive $68,340 bet just hours before the market closed. Just slammed it down.
Confident bet.
Extremely. And get this, the account was only a few weeks old and had only traded the single Nobel Prize market. Classic insider pattern, right? Laser focus.
Textbook. And the Norwegians noticed.
Oh, yeah. The Norwegian authorities took it super seriously. They launched a formal criminal investigation into the leak itself. They're treating it like potential espionage or some major internal corruption because that winner information is basically state secret level for them.
Okay, so Norway is investigating the leak. But what about the traders in the U.S. who actually made the money? The ones who took profit out of Polymarket?
Completely safe. Totally fine. They cashed out, got their full $1 per share payout, zero legal risk under U.S. jurisdiction. They literally exploited the exact regulatory gap we're here to research in detail today.
So if you're a professional listening, you absolutely need to understand this mechanism.
Yeah.
Because this is where the premium, the real premium on intelligence is being paid right now, legally.
Without question.
Okay, let's unpack this properly. When we were doing deals, back in the PE and M&A days, the whole regulatory framework, everything hinged on avoiding SEC trouble. Rule 10b-5 was basically tattooed on our brains.
Oh, absolutely. Compliance was everything.
We always valued information asymmetry.
Yeah.
I mean, that's the business. But stepping over that SEC line, huge career risk, potentially life-altering. So why does the platform suddenly matter more than the confidential information itself?
It boils down to legal classification. That's the bedrock of this whole arbitrage. Simple as that, almost.
Classification. Okay.
In traditional finance, insider trading is governed by SEC Rule 10b-5, like you said, and that rule, crucially, applies only to instruments classified as securities.
Stocks, bonds, investment contracts, the usual suspects.
Exactly. The SEC's whole framework is built on the idea that corporate insiders, executives, directors owe a fiduciary duty to their shareholders, a duty of trust and confidence.
Right. That duty is the hook.
It is. When they trade on confidential company information that belongs to the company, they're breaching that duty. They're essentially stealing corporate property for personal gain. That makes the trade inherently fraudulent under securities law.
And that fiduciary duty makes it relatively straightforward, legally speaking, for the SEC to go after them once the timing looks suspicious. The duty is presumed based on their position.
Precisely. And they do go after them. The SEC is robust in enforcement here. Fiscal year 2024 alone, they brought 35 insider trading cases. The system is specifically designed to police that relationship, the insider versus the shareholder, protect the investor.
Okay, but these prediction contracts on Polymarket, will Trump win? Or will Taylor Swift get engaged? Those aren't shares of Apple stock. They're not corporate securities.
They absolutely are not, and that's the key. They are classified explicitly as swaps under the jurisdiction of a different regulator, the Commodity Futures Trading Commission, the CFTC.
Ah, the CFTC, Commodities Futures Swaps. Different world.
Completely different world, different history, different rules. And this classification wasn't just assumed. The CFTC actually settled with Polymarket back in 2022. That settlement order explicitly established these event contracts as swaps, cementing their place outside the SEC's securities domain.
So that jurisdictional shift from SEC to CFTC, that's the magic door.
Yeah.
That's the difference between facing prison time and walking away with tax-free profits. Well, not tax-free, but legally obtained profits.
It is everything. Now, to be clear, the CFTC does technically have a rule, Rule 180.1, that prohibits fraudulent trading based on material non-public information.
Sounds similar.
It sounds very similar.
Yeah.
So where's the gap? The gap is in the burden of proof. It's dramatically different, and that's where the arbitrage really opens up wide. To prosecute under CFTC Rule 180.1, the regulators have to prove that the information was obtained specifically in breach of a pre-existing duty, like a confidentiality agreement, or through outright fraud or deceit, like hacking or theft.
Wait, let me pause on that pre-existing duty part, because this feels critical. In corporate finance, like we said, my duty as an exec is basically built into my job title, my relationship with shareholders.
You're right.
But if I'm just some trader betting on oil futures or, say, a Polymarket contract about a political election,
Yeah.
I don't owe any fiduciary duty to the person on the other side of that bet, do I? They're just some anonymous counterparty.
Exactly right. You owe them nothing beyond honoring the contract terms. So is the CFTC rule really designed more to catch things like industrial espionage, someone breaking a specific NDA, or maybe a journalist selling their scoop early before publication, rather than just someone who's frankly better connected or did better research?
Is that the distinction?
That is the perfect historical and practical distinction. Commodity law grew up around hedging risk in physical markets. Think about a giant energy company buying natural gas futures to lock in prices because they know their operational needs are going up next quarter.
They definitely possess superior material, non-public information about their own needs.
Absolutely. But that's not considered fraud in the commodities world. That's just smart business. Hedging risk. In commodities, having superior information, an edge is expected. It's rewarded. The law generally only steps in if you corrupt the process of getting that information, hacking, bribery, breaking a specific legal duty.
So, okay, let's apply that. If I hack into the FDA servers to get the drug rejection notice early,
Yeah.
that's obviously fraud, that's a breach. I'd be in trouble with the CFTC and probably the FBI too.
Definitely.
But what if I hear about the impending rejection from, say, a well-connected friend who works at a lobbying firm? And I haven't signed any NDA with them. I haven't promised confidentiality. Have I breached a pre-existing duty?
Under the current CFTC framework as applied to these markets, almost certainly not. You've just exercised superior intelligence gathering. You've tapped your network.
Wow. So you see the chasm opening up right there.
It's huge because these prediction contracts, they don't involve that specific corporate insider to shareholder relationship. Proving that a specific legally recognized duty was breached becomes incredibly difficult, almost impossible, especially in a market where everyone is just a pseudonymous wallet address.
And the practical result of this high burden and lack of relationship? Zero enforcement. That's the really staggering part for me.
That's the bottom line. The CFTC has brought exactly 0 enforcement actions specifically for insider trading on prediction markets, despite multiple documented, highly suspicious cases involving millions in profit.
0. Why? Is it just lack of interest? Resources? Or do they maybe even implicitly approve?
It's likely a combination. Minimal institutional focus, certainly resource constraints compared to the SEC's insider trading unit, and perhaps a philosophical leaning towards letting these markets develop, seeing them more as information aggregation tools than securities markets needing investor protection. They are, in effect, institutionalizing this regulatory gap through inaction.
Okay, let's crystallize the arbitrage opportunity with an example everyone in finance gets, the classic pharma insider trade scenario.
Perfect. Imagine you're a mid-level executive at a biotech firm. You just found out internally, definitively, that the FDA is going to reject your company's major blockbuster drug application next week. Huge negative news.
Okay, so option 1, traditional markets.
Option 1, you short your company's stock or buy puts based on that confidential knowledge. What happens?
You're toast. SEC investigation, likely criminal charges from the DOJ. You're looking at a federal felony conviction, possibly years in prison, massive civil fines, typically up to 3 times your profit, Right. or avoided loss plus disgorgement. Your career is over. Maybe your life is ruined.
Exactly. The SEC makes examples of people like that all the time. It's core enforcement.
Okay, option 2, the Polymarket route.
Option 2, instead of touching your company's stock, you log on to Polymarket. You find a contract asking, will the FDA approve drug X by Q3 2026? And you simply bet no. Heavily, you are monetizing the identical internal, non-public material information. What happens now?
Nothing.
0 violation under current interpretations. 0 legal risk. You collect your winnings when the no contract settles at $1 after the public announcement. You keep every single penny of the profit, well, minus platform fees.
Identical information. Identical intent to profit from non-public knowledge. Diametrically opposite legal consequences.
That is the arbitrage. It's the cleanest, starkest regulatory arbitrage we've seen, maybe ever, certainly in modern finance. It's driven purely by the classification of the betting instrument.
This is where it gets, really interesting for us tracking the signals. Because the theory is one thing, but it's backed up now by hard forensic evidence from the blockchain. We're moving past legal theory into observing real-time proof that highly sensitive info is being traded instantly.
Right. And we can circle back to that Nobel Peace Prize case again, because it's just the perfect illustration of timing precision, the apex predator of timing, you might say.
So the committee finalized the decision 4 days before the announcement, right? But the big money didn't move until 11 hours out.
Exactly. And the way it moved is the tell. The price action itself is basically the smoking gun. It wasn't a gradual accumulation based on rumors.
Describe what the market looked like in those final 11 hours. Was it tentative, or was it like a certainty switch flipped?
It was a vertical confirmation of certainty, like someone flipped a switch, exactly. For weeks, maybe months before, Machado's yes shares were just bumping along the bottom. 3 cents, 5 cents, maybe 8 cents on a good day, total irrelevance. Then, around 1:00 a.m. Central European Time, 11 hours before the announcement, the order book just lit up on the buy side. The price didn't creep, it vaulted. Blew past the 50% mark, the point of implied certainty, within just a few hours. It signaled that definitive knowledge had entered the market.
And Dirty Cup, the big account. They weren't trying to be subtle.
Not at all. They didn't nibble around the edges. They dropped that huge $68,340 block order pretty close to the end, hours before the market effectively closed at the announcement. Just pure conviction.
And because they likely knew they faced no U.S. prosecution, they could afford to be bold. They didn't need to hide their tracks in the same way a stock trader would.
Precisely. And the fact that Norway launched a formal criminal investigation into the leak, they see this as a major breach of their sovereign process, while the U.S.-based traders who profited are completely untouched. It just throws this stark legal and political asymmetry into sharp relief, doesn't it?
It absolutely does. They're essentially using a U.S. regulatory classification loophole to shield themselves from the consequences of actions being investigated by a close U.S. ally. That's quite something.
It's a fascinating dynamic.
Then you have maybe my favorite case, just because it's so specific.
Yeah.
The celebrity inner circle trade, the Taylor Swift and Travis Kelce engagement market. You gotta love it.
Right. This one is all about monetizing private, really intimate knowledge. So the public announcement hits the newswires August 26, 2025 at 1:00 p.m. Eastern Time. Okay.
Got it.
But we know from reporting that the actual engagement happened about 2 weeks earlier, and that knowledge was kept super tight, basically just immediate family and maybe a few very close friends, the innermost circle.
Okay, so extremely non-public. Now, the timing of the trade.
This is just incredible. 14 minutes.
14 minutes before the public announcement.
Yep. At 12:46 p.m. Eastern Time, just 14 minutes before People magazine or whoever broke the story, a user identified as Romantic Title suddenly buys 1,200 Yes shares on the engagement contract.
Wow, cutting it fine.
Extremely fine. Now, this Romantic Rapal wasn't a brand new account. They had some history. But the timing and size of this specific purchase, right before the news broke, it screams acting on pre-release information.
Had to be. And they weren't the only one.
No. Another unidentified trader apparently went even bigger, wagered about $12,000 just before the announcement, and walked away with over $52,000 in profit in minutes.
52 grand for being, what, maybe 2 degrees of separation from the family group chat, maybe even 1 degree.
Could be. That's the value of that proximity, monetized instantly with zero legal fear. It really underscores how this market normalizes acting on information that is absolutely 100% restricted and off limits in basically every other sphere of life and finance.
It really does. And it brings up that constant tension, right? Where does just really good analysis or being incredibly well connected end, and where does actual verifiable inside knowledge begin?
That's the central enforcement challenge for the CFTC, even if they wanted to police this aggressively. How do you prove it wasn't just smarts or luck?
We saw that tension play out very clearly in a much bigger market, the Biden withdrawal situation in 2024.
No, absolutely. Remember, President Biden dropped out of the presidential race on July 21st, 2024, and it caught almost everyone in traditional media, political punditry, even many party insiders completely by surprise.
Total shock for many. But Polymarket.
Polymarket was way ahead. 3 weeks before the official announcement, the odds on Polymarket for Biden withdrawing had already climbed past 50% and were hitting 70% probability. The market was screaming that it was going to happen.
Weeks in advance.
Oh.
So the big question, was that an insider signal? Was it, White House staff, senior Democratic Party officials, maybe even family members, quietly placing bets because they knew the decision was imminent or already made? Or was it the genuine wisdom of crowds effect? Was the market just brilliantly aggregating all the publicly available signals, the shaky debate performance, the mounting public pressure from commentators, the subtle shifts in party messaging, and processing it much faster and more accurately than traditional polling or media could?
And that is the fundamental impossibility the CFTC or any regulator faces in this context. They can see the outcome. The market accurately predicted the event weeks early. Superior information aggregation clearly occurred.
No.
But they cannot definitively prove how that aggregation happened. Was it a collective emergent judgment based on public data? Or was it driven by a few large pseudonymous wallets belonging to actual political insiders who were acting on concrete, non-public knowledge?
The market simply read the tea leaves incredibly well. Or maybe someone read the actual resignation letter draft before it was announced. And the CFTC can't tell the difference just by looking at the blockchain data.
Exactly. The blockchain shows the trades, the timing, the volume, but it can't read the why the trader's state of mind, their source of information, or, crucially, whether they breached any specific legally defined duty in obtaining that information. And without that breach of duty under CFTC rules, there's basically no case.
Which brings us to the scale of this whole operation. Because this isn't just a few tech bros gambling in a corner anymore, is it?
Not even close. We need to talk about the sheer scale and the sophistication here. This isn't a niche market operating on the fringes. It's attracting serious institutional-level capital and utilizing pretty high-tech trading strategies.
The amount of money flowing through Polymarket alone should make every finance professional sit up and pay attention.
Absolutely. So Polymarket, founded back in 2020 by Shane Copeland, it's built on the Polygon blockchain, uses the USDC stablecoin for settlement, so it's tied to the dollar, and crucially, functionally, it operates like a sophisticated central limit order book exchange.
Okay, that CLB comparison central limit order book, that's really key, isn't it?
Yeah.
It means it's not just some bucket shop. They provide real market structure.
Exactly. You get transparency on bids and asks, you get real-time price discovery, you get rapid execution, and it's all recorded immutably on that public blockchain ledger.
And the numbers, the volume metrics.
They're staggering. As of late 2025, Polymarket has processed nearly $21 billion in cumulative trading volume since inception.
21 billion.
Billion with a B. And just on the 2024 U.S. election markets alone, they did something like $3.3 billion in volume.
That's massive.
Yeah.
What about the valuation of the backers?
The platform itself is reportedly valued somewhere in the $8 to $9 billion range. It's backed by about $2 billion in venture capital from some huge names. You've got Peter Thiel's Founders Fund, Ethereum founder Vitalik Buterin, and maybe most tellingly, the Intercontinental Exchange.
ICE. Hey, as in the owners of the New York Stock Exchange.
The very same. The people who run the single most heavily regulated, iconic stock exchange in the world are significant investors in Polymarket.
Okay, wow. If that doesn't signal institutional confidence in the future of this regulatory arbitrage, I don't know what does.
Yeah.
They clearly see a massive frontier market here.
It's undeniable. They're betting big that this model is here to stay and grow, which leads us right into that classic crypto paradox, the anonymity versus transparency thing.
Right. The platform prides itself on being permissionless, right?
Yeah.
No KYC.
Correct. Zero informants. Know your customer requirements. No need to provide your name, your ID, your email, nothing. You just connect a self-custodial Web3 wallet like MetaMask or whatever. And your identity on the platform is simply that 42-character hexadecimal wallet address. That's it. That anonymity, that permissionless ethos, it's fundamental to their whole value proposition.
So total anonymity on the front end.
Total transparency on the back end. That's the paradox.
The beautiful, terrifying paradox, yeah.
Because every single transaction, every bet placed, every order filled, every contract settled, it's all permanently and publicly recorded on the Polygon blockchain. Anyone can view it.
Which ironically makes it a playground for forensic analysts.
Exactly. This public ledger enables really sophisticated analysis from firms like Chainalysis, Elliptic, Nansen, you name it. They specialize in de-anonymizing patterns on the blockchain.
How do they do that? What are they looking for?
They use techniques like wallet clustering, identifying groups of addresses likely controlled by the same entity by analyzing funding sources, transaction timings, common counterparties. They track the flow of funds. And they look for the Achilles heel, the exit ramp.
The exit ramp, getting the crypto winnings back into real money.
Precisely. Eventually, most people want to convert that USDC profit back into dollars or euros or whatever. And usually the easiest way to do that at scale is through a centralized cryptocurrency exchange like a Kraken or a Coinbase or Binance.
And those exchanges do require KYC.
Bingo. Those regulated exchanges absolutely require identity verification. So if law enforcement ever got serious and subpoenaed those exchanges, they could potentially link that pseudonymous Polymarket wallet address back to a real-world name and bank account. The trail exists, even if it's obscured.
Interesting. So the anonymity isn't absolute. It's more plausible deniability unless someone really digs.
That's a good way to put it. And this forensic capability, this ability to cluster wallets and track flows, is exactly how researchers were able to identify the enormous influence of perhaps the single largest known player on the platform, the so-called French whale.
The French whale.
Hey.
Pseudonym, Theo, right? Tell us about him.
Yeah, Theo. This entity, likely a single sophisticated trader or maybe a small group operating together, controlled at least 11 different wallet addresses that were clustered together through forensic analysis. Names like Freddy 99999, Theo, Princess Taharo, all linked.
Okay, so operating under multiple identities. And the scale of his betting.
Astronomical for this market. This cluster wagered over $70 million just on contracts related to Donald Trump winning the 2024 election.
$70 million on prediction markets.
$70 million, and his return on that massive bet, a reported profit of $85 million.
$85 million profit off a prediction market. That's hedge fund level money.
It absolutely is. And this wasn't just a passive long-term hold either. Thea's clustered accounts were incredibly active. At their peak, they held something like 25% of the total open interest in the main Trump Electoral College contracts. Huge concentration.
So he basically was the market, or a huge chunk of it.
He had enormous influence on the odds. His trading strategy was also revealingly sophisticated. During periods of high political uncertainty, his accounts were executing over 1,600 trades in a single 24-hour period.
Wow. High frequency on a prediction market.
Yeah, and he was strategically mixing large block trades like precisely $4,302 transactions, repeated often with tiny, almost dust-like trades of like $0.30.
Why do that? Obfuscation.
Likely two reasons. One, to mask the true scale of capital being deployed, make it harder to see the giant footprint. Two, to carefully manage the price impact of his own buying, avoid pushing the odds up too sharply against his own entry points too early. It's classic proprietary trading desk behavior applied to political prediction markets.
Absolutely. Accumulating a massive position without spooking the market. So, did Polymarket see this as manipulation?
Interestingly, no. Polymarket conducted its own internal investigation into Theo's activity. Their public conclusion was that they found no evidence of efforts at market manipulation.
Seriously, how did they explain the $85 million profit then?
They attributed Theo's incredible success not to, say, having access to internal campaign polling or some other non-public edge, but simply to superior proprietary analysis. They specifically mentioned his use of his own neighbor polls, basically, conducting his own independent polling.
Right. So again, we hit that wall. Is $85 million the fair reward for brilliant independent analysis and polling that massively outperformed the mainstream? Or is it the payoff for privileged information flow, maybe access to internal campaign data, donor sentiment, something else that we simply cannot prove was obtained through a specific breach of duty?
And the platform itself leans towards the superior analysis explanation, which is understandable, but the sheer concentration is undeniable.
Yeah, knowing that the top 5 holders in these major political markets often control 50% or more of the outstanding shares, it really challenges that simple wisdom of crowds narrative, doesn't it?
It certainly suggests that prices often reflect the deep convictions of a few very large, very informed whales, rather than a purely democratic aggregation of small bets. This isn't your local betting pool. It's a serious vehicle for sophisticated, informed capital to express high-conviction views.
Okay, let's really hammer home the asymmetry here.
Well,
If you executed that Theo trade, wagering $70 to make $85 based on, let's just hypothetically say, non-public campaign info, but you did it using options on an ETF tracking political sentiment or some related stock. What happens?
forget about it. You'd have the SEC crawling all over you instantly. The FBI would likely get involved, coordinating with the U.S. Attorney's Office. You'd be looking at a massive criminal indictment for securities fraud, wire fraud, maybe conspiracy, years in prison, hundreds of millions in fines and disgorgement. Game over.
But because Theo did it using CFTC classified swaps on Polymarket.
He collects his $85 million profit, pays his taxes, hopefully, and starts scouting the next big political or event-driven arbitrage opportunity. Zero criminal exposure in the U.S. for the trade itself.
That contrast is just wild.
Wow.
It creates such a clear, almost perverse incentive structure.
Absolutely. And to truly grasp how different the enforcement environments are, it's really useful to compare it directly with another area where regulators do care deeply about non-public information being used for betting. Sports.
Yes. The sports betting parallel is perfect because the dynamics are identical, right?
Yeah.
Exploiting inside knowledge about an athlete's hidden injury or a coach's secret game plan or a fixed outcome that's conceptually the same as trading on an unannounced FDA decision or earnings miss.
Exactly the same principle. But the regulatory infrastructure and enforcement attitude are night and day different.
How does it work in sports betting since the Supreme Court decision in 2018 opened the doors?
Since 2018, federal prosecutors have become incredibly aggressive. They actively use sophisticated surveillance techniques. They coordinate closely with the licensed sportsbooks, DraftKings, FanDuel, etc., who, crucially, all require strict KYC identity verification. And they bring criminal cases using federal wire fraud statutes. The pathway to prosecution is clear, well-trodden, and severe.
Give us an example. The John T. Porter NBA case from 2024 was pretty high profile.
Textbook case. Porter, an NBA player, conspired with bettors. The plan was for him to bet on his own statistical unders, meaning bet that he would perform poorly in certain statistical categories.
Betting on himself to fail.
Essentially, yes. He texted his co-conspirators confirming he would exit a specific game early, claiming a fake illness or injury. He played just 4 minutes in that game. One of his associates placed a $10,000 bet on Porter's unders and won $85,000.
Okay, blatant manipulation. How did they get caught?
The licensed sportsbook, DraftKings in this instance, has sophisticated algorithms monitoring for suspicious betting patterns. They flagged a subsequent, even larger attempt, an $80,000 parlay involving Porter's unders that would have paid out $1.1 million. DraftKings detected the highly unusual activity, froze the payout, and alerted the authorities and the NBA.
And the consequences for Porter?
Swift and severe. He received a lifetime ban from the NBA. And more importantly, he pleaded guilty to federal wire fraud conspiracy charges. He's facing likely 3.5 to 4 years in federal prison. The system worked exactly as designed. KYC allowed identification, surveillance flagged suspicious bets, and the wire fraud statute provided the tool for criminal prosecution.
And this wasn't an isolated incident, right? It seems like enforcement in sports is ramping up.
Definitely. Just in October 2025, there was a huge sweep. Federal arrests of 34 people, including active NBA players like Terry Rozier and even a head coach, Chauncey Billups, all on wire fraud conspiracy charges related to sharing inside information for betting purposes.
What was Rozier accused of doing?
Similar scheme. The indictment alleged Rozier told a friend he planned to exit a game early, again citing a fake injury. His co-conspirators then allegedly placed over $200,000 in wagers based on that inside knowledge. The feds even had evidence of them counting the cash profits together afterwards.
Wow. So the key difference is the regulated environment. KYC, surveillance, and the clear application of wire fraud laws by motivated prosecutors.
That's exactly it. The licensed sports books provide the data trails and identities needed for law enforcement to build these wire fraud cases relatively easily when there's clear evidence of cheating or inside info being used.
Okay, let's quantify this enforcement gap one last stark time. Traditional securities markets, SEC enforcement is active, penalties are brutal. Think Rajratnam getting 11 years in prison for making around $63 million profit. Martha Stewart served 5 months just for avoiding a $45,000 loss. The system aims to deter.
Right. Now contrast that with prediction markets like Polymarket. Documented suspicious trades netting hundreds of thousands, even tens of millions, like Theo's $85 million win. What's the enforcement record? 0 criminal prosecutions. 0 civil penalties sought by the CFTC for insider trading. 0 disgorgement orders. Nothing. The consequence for monetizing identical material non-public information is wildly, fundamentally divergent, based purely on the type of contract traded.
And that divergence creates this massive systematic incentive. It's almost irrational not to use Polymarket if you have valuable inside info.
Think about it from the perspective of, say, a corporate employee. Why on earth would you risk a felony conviction and ruin your life by shorting your company's stock right before bad earnings are announced?
When you could just
go onto Polymarket, bet no on a contract asking, will company X meet Q4 earnings estimates? Monetize the exact same signal derived from your internal knowledge, pocket the profit, and face absolutely 0 legal scrutiny from U.S. regulators.
It becomes the logical, risk-adjusted choice. This isn't just for corporate insiders either, right? Journalists with scoops, political operatives with campaign data, FDA reviewers. Anyone with valuable, time-sensitive, non-public event information now has a readily accessible, seemingly legal monetization channel.
It fundamentally reshapes the entire landscape of information advantage. We've built this system where knowledge is power, obviously, but now one specific corner of the financial market has effectively codified, through regulatory classification and enforcement neglect, the ability to trade on that power without consequence. It forces us to ask, what does this actually mean for the future of information itself? And for market fairness?
Yeah, this tension, the classic tension between market efficiency and market fairness feels like it's right at the philosophical core of this whole Polymarket phenomenon. And both sides have pretty compelling arguments, don't they?
They really do. On the efficiency side, you have proponents, often economists, libertarians, and the platform advocates themselves arguing that allowing insiders to trade actually improves the market's accuracy and speeds up price discovery.
The argument being that insiders are, by definition, the most informed participants. Excluding them makes the market dumber.
That's the gist. Look at Polymarket's track record. It demonstrably outperformed mainstream polls in predicting the 2024 election outcome. It signaled Biden's withdrawal weeks ahead of the press corps. The argument is, if your primary goal is creating the most accurate possible forecast of future events, you want the insiders participating. Prohibiting them actually makes the market less efficient, less accurate.
Okay, that's the efficiency argument. What about the fairness side? The critics.
The fairness argument focuses more on the systemic risks and the potential for perverse incentives and conflicts of interest. If you legalize insider trading in these markets, what happens?
Well, you could have politicians betting against the success of their own policies to make a profit. You could have corporate executives delaying or timing the release of material news specifically to maximize their personal Polymarket positions before the public finds out. It could corrupt the actual decision-making processes themselves.
Exactly. It creates potentially massive conflicts of interest that undermine trust in institutions and corporations. Plus, critics point to the market concentration we talked about.
Right, the whales dominating the price action.
If the top 5 wallets control 50% of the shares in major markets, is the price really reflecting the aggregated wisdom of the crowd, or is it just reflecting the high conviction and potentially insider knowledge of a few massive players? It feels less democratic, more oligarchic.
And fundamentally, who is actually paying for these huge insider or whale profits? Where did the money come from?
That's the other uncomfortable truth. Analysis of Polymarket wallet data suggests only about 12.7% of all participating wallets are profitable overall.
So nearly 90% are losing money.
Pretty much. The vast majority of participants, likely smaller retail bettors attracted by the hype or the gambling aspect, are effectively providing the liquidity. They're the ones consistently losing money, which then flows upwards to the sophisticated, informed traders and the potential insiders who have the real edge. It's a wealth transfer mechanism in a way.
Okay, so we have this booming market, billions in volume, major institutional backers like ICE, clear evidence of insider-like trading patterns, but zero enforcement from the supposed regulator, the CFTC. What's the outlook? Is Congress going to step in? Is the CFTC going to wake up and change its tune?
Honestly, minimal near-term change is the most likely scenario, which strongly suggests this arbitrage opportunity is becoming institutionalized, at least for the foreseeable future.
Why so little expected change?
Well, the CFTC itself has generally taken a deliberately pro-innovation stance towards crypto and fintech. They've issued no action letters allowing certain types of event contracts in the past. They seem more focused on clarifying their jurisdictional boundaries with the SEC and enabling market growth, rather than imposing heavy SEC-style insider trading restrictions on instruments they classify as swaps.
And the big money investment, like from ICE, probably creates political inertia too.
You have to assume so. When the owner of the NYSE invests billions in a platform valued at $8 and $9 billion based largely on this regulatory setup, it creates powerful stakeholders who will lobby hard against any changes that threaten the model. Absent a massive scandal or a complete political reversal, the path of least resistance is maintaining the status quo.
Which means the long-term arbitrage, the ability to legally trade on material non-public information using swaps while facing prison for using securities, is likely set to continue. This bifurcated system seems locked in.
It does. The legality of your multi-million-dollar profit hinges entirely, almost absurdly, on which regulatory box your chosen financial instrument falls into. CFTC swap or SEC security. The choice of instrument, not the nature of your information or your intent, is the determining factor.
So wrapping this up, we've researched in detail today how this fundamental classification difference swap versus security is literally the only thing standing between a perfectly legal massive profit and a potentially career-ending federal prison sentence.
It's a conscious policy choice made, or perhaps unmade, by regulators. And right now, that choice clearly favors rapid information aggregation and market efficiency in the prediction market space, prioritizing it over the traditional principles of market fairness and equal access to information that supposedly underpins securities law.
Which means for everyone listening, tracking these prediction markets like Polymarket is no longer just about political junkies having fun or making side bets. It's about watching a real-time public ledger of where serious institutional capital and very likely superior insider information are flowing when the traditional regulatory walls are effectively down.
It's the ultimate raw insider signal, broadcast publicly but interpreted legally in a completely novel way.
It tells you so much about the true value placed on speed, on information advantage, and maybe the perceived cost or friction of traditional regulation in the modern financial environment.
Absolutely. It's a live experiment in information markets.
Okay, I've got a final provocative thought for you, something for listeners to mull over, especially those working in or around public companies. Given how frequently corporate events think FDA approvals, M&A deals falling through, maybe even surprise executive resignations are now being actively traded on Polymarket before the public announcement. If a company's own highly sensitive, internal, material, non-public information can be legally monetized by its employees or connected individuals on Polymarket, will corporate boards and internal governance bodies eventually have to start treating significant Polymarket positions as a material conflict of interest that needs disclosure and management, even if the government regulators aren't policing it?
Ooh, that's a fantastic question. Like, should it be part of the corporate compliance policy, even if it's not illegal externally?
Exactly. Could we see companies start prohibiting their executives from trading Polymarket contracts related to the company or its industry, purely from an internal ethics and governance perspective, to avoid the appearance of impropriety or compromised decision-making. That feels like the next messy frontier where information advantage, corporate ethics, and this new technology are going to collide.
That is the billion-dollar or maybe multi-billion-dollar governance question that boards are going to have to wrestle with very soon, isn't it? Fascinating angle to track.
Absolutely fascinating. We'll definitely be keeping an eye on it. All right, that's all the time we have for today. Until next time, keep tracking those signals.